Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. I'm going to talk a little bit about China again this week. Listeners might recall last week, myself and our China chief economist, Pei-Shin Liu, spoke about developments in the region with the lockdowns and reactions from the government, and also the downside risks to growth. And that came to the fore this past week, especially early in the week, with Chinese financial markets tumbling, Chinese yuan weakening, and developed market rates also heading lower as financial markets and equity markets in other regions also followed suit. Interestingly, on the FX side, the dollar continued to be bid, despite actually U.S. yields starting to fall a little bit. The U.S. narrative shifted from one of monetary policy rate differentials to more of, if the U.S. or the world, I should say, is heading towards a little bit of more concerns around a slower growth, that the U.S. is probably still best situated. So more of a U.S. exceptionalism narrative that we were used to a few years ago. I mean, as for rates, I do think that for the U.S., at least I should say, this brought some balance into the rate markets. As listeners might recall, we've turned positive on U.S. 10-year yields up against 3%. But with the Fed meeting next week, I would call this new bond bullishness a tentative one, just because we expect volatility to continue and market reactions to the Fed this coming week can be quite unpredictable, especially now given the weakening prospect for Chinese growth in the background and a myriad of other cross currents in geopolitics and different economies. As a reminder, we do see a 50 basis point move and announcement of QT from the Fed, but that's pretty much baked in the cake when it comes to markets. So we'll be mostly looking at Powell's press conference and the tone he has about the forward nature of policy, and if he shines any new light for markets on their outlook. So, as also discussed lately, our expectation is that some of the concerns in the market will shift to the overall global growth outlook, as the cost shock, not just Chinese growth, but the overall cost shock to the world's consumers start to weigh. Nowhere does it seem to be more apparent actually than the UK. And I have to admit, I have this first in, first out thought in my mind, where the Bank of England last fall was the first to turn hawkish. So is it possible that they're going to be the central bank that actually first eases off the hawkish brake, I should say, and may be the first to have a more balanced approach. So on that, I have Ross Walker, our chief UK economist and head of global economics. So Ross, I do want to talk about the UK, but I also want to say near term, your thoughts on the broader kind of global consumer, given some of the cost shock we're seeing. Given what I mentioned about the cost shock that consumers are facing, how worried should we be and where should we be most worried?
Yes, well, nowhere we think is immune. There is an energy shock, increasingly evident, a generalized tradable goods shock, evidence everywhere, but the problems do seem more pressing, more acute in the Euro area and the UK, the US being a little bit more insulated. But even there, you saw recent conference board data showing a further dip in confidence, and certainly the forward-looking expectations measures have fallen a bit more. Now they can be a bit more sensitive, a bit more cyclical. It doesn't necessarily translate short-term moves in some of those sentiment indicators, don't necessarily translate reliably into actual spending behavior. But when you look at what we're seeing in Europe and the UK in particular, where households are essentially today telling us that they are about as pessimistic about their own financial prospects as at any time since the global financial crisis. This is a concern. There is a clear recognition that this squeeze is beginning to bite. It still has some way to run. So I think around the turn of this year, fourth quarter of this year, beginning of next year would be, I think, the point where those household expenditure numbers could be under most pressure. And if we are going to get negative GDP prints, even a technical recession, it would be around that time. I think there's still a little bit of a lag. This still has to play through a little bit in terms of actual spending behavior. But the headwinds are now, and we're probably not too far away from pretty shaky consumer expenditure data.
All right, so most of this cost shock they're seeing is really from the supply side of things, so it's not quite under central bank control. But central banks are doing what they can, which is trying to rein in demand to bring those curves more in balance. So does that mean the threshold for all these central banks to stop hiking is higher than before? And isn't that kind of a risky strategy? Obviously, we have to get inflation under control. They have to, keep their inflation expectations under control and their reputation. So, but how worried are you about the risks of that?
Yes, the policy dilemma has only increased in recent months. And in this respect, maybe the Bank of England is informative. As you say, they were one of the early tighteners trying to front load policy. But in recent months, the signalling has been that actually there's much more nervousness about the hit to demand. And therefore there is a sense that although we almost certainly get a few more rate rises over the summer, the terminal rate for now is a bit nearer, and they will want a little bit more time to assess the hit to demand. But I think here there is a big transatlantic divide. That there is clearly much stronger demand in the US, less spare capacity, a labour market that looks much stronger, certainly wage inflation pressures that are building more. Whereas on the European side, it does seem to be more of a supply side issue. You see that reflected in the inflation data. Core inflation in the euro area, certainly in the UK to some extent, remains some way below the trends we're seeing in the US.
All right, so narrowing on the UK a little bit, we do have the Bank of England meeting next week. So two questions. What do you see there just from a high level? And given all these issues and some of the things you're talking about with the UK and the Bank of England flagging some of the consumer issues, have you changed your growth and inflation forecasts at all around that?
So for next week's meeting, a quarter point rise, I think anything other than that would be a big shock for markets. But I think it's probably a more dovish rate rise in the sense that if we do get dissenting votes, it will be one or two members voting for no change rather than for larger increases. The other key thing will be in terms of the forecasts that the BOE produces and the implicit policy signal. The previous two or three forecast rounds from the BOE have essentially signaled that they think bank rate only needs to rise to around 1.25%, maybe a little bit higher, but we're obviously closing in on those levels. So any sort of further dilution of their inverted commas hawkish policy guidance would clearly be significant. I'm not sure that we're completely done in terms of the UK tightening cycle, but I think once we get, say, beyond August, the probability of some pause for a quarter or two to assess that hit to the consumer seems much more likely, and there is therefore a possibility that they do need to resume tightening next year. And who knows? They could be in a position where they are seen to be further behind the curve. So I think policy could get much more volatile later in the year. But for now, it feels like there's just a sort of an easing in terms of foot on the brake. So probably an important policy meeting to watch in terms of where other central banks who began a tightening cycle a little bit later may go subsequently. And on the economy in general, we've had for some time a more marked slowdown in the consumer. We are, as I say, flirting with a sort of consumer recession around the turn of the year, not quite our central case. We still do have a big fiscal support. It's not as big as in the previous year, but it's still significant. We still have a window where there are quite big tax allowances for business investment. So it's been very stop-start capex, but we might just get some temporary support as firms try to take advantage of those generous tax allowances. So net, we see GDP growth slowing abruptly to around 0.2% quarter-on-quarter growth around the turn of the year. And once you're into that sort of territory, you're only really a small forecast adjustment, a rounding error away from a negative quarter and even a sort of technical recession.
Yeah, and that's two things off that. First, your policy volatility comment from Bank of England. I think that actually holds for the Fed too, because we kind of have these series of 50s baked into expectations, and I think they're highly likely to occur. But then, depending on whether inflation comes down, demand holds up, we could see those extend. We're currently thinking 25s right now, or something break on the way, and they actually have to back off a little bit from those expectations. So volatility and policy, is for sure going to be coming. And then just for listeners, when you talk about that one one little trade change away from a negative number because of the recent trade data and because of some of the weakness from inventories. We actually have a negative forecast for US GDP. Now, that's mostly trade and inventories, so we shouldn't read too much into that as far as because the underlying consumptions say it's like the economy is doing pretty well there in the US. But the headlines in the newspapers will probably be all over it. So how does that impact consumer confidence at a time it's already declining? Could be an interesting dynamic. So, all right, well, that's it for this week. Thank you, Ross, for joining us. Much appreciated. Next week, we're headlined again by the FOMC and the Bank of England meetings. Ross outlined his BOE view, and for me, again, I think that Powell's press conference is the key, less really what their action is going to be, because that should be pretty well signaled. We also have the usual top-tier data in the U.S., like ISMs, we have global PMI data, and German unemployment. But most of the events seem to be, in the U.S., UK. But as this week reminded us, always keep an eye out here in Asia as well, especially developments around any sort of further lockdowns around Beijing or potentially, hopefully, loosening them. So thank you very much. Have a good week.
I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.